Welcome back to another edition of The Deep Dive. Today we are opening up the hood on a situation that I think drives most retail investors absolutely, well, crazy.
Oh, yeah.
You know the drill. You watch a company report earnings, the headline numbers look fantastic, revenue is up, profits are surging, they even raise their guidance for the future.
You're thinking you've got a winner.
You think, okay, great quarter, time for the stock to rip.
And then you look at the after-hours chart, and it looks like it fell off a cliff.
Exactly. It's a bloodbath. The stock nosedives.
Yeah.
That is precisely what we are dissecting today with Toast ticker symbol TOST. They just dropped their Q4 and full year 2025 numbers. On paper, it looks like a victory lap.
A total victory lap.
In the market, it looked more like a panic stop.
It is the classic beat and drop, but when you peel back the layers on this one, it's not just about the numbers. It's about an identity crisis. Toast is trying to graduate. They don't want to just be the iPad at your local coffee shop anymore.
Right.
They are pitching this massive shift to become the, quote, operating system for all local commerce. We're talking retail, enterprise, international, the whole 9 yards.
But the market got hung up on a memory chip.
A literal microchip.
It's almost funny if it weren't so painful for shareholders.
Yeah.
We are absolutely going to get into that because it's a fascinating lesson in how hardware economics can just drag down a beautiful software valuation.
Oh, okay. So here is the mission for this dive. We are going to unpack the headline beat to see if the growth is actually real and sustainable.
Mm-hmm.
We are going to look at this unified local shelf strategy, which is a very fancy way of saying they want to track every steak and bottle of wine in existence. We'll look at their AI defense, and then we have to figure out why a tiny rise in component costs tanked the stock nearly 6%.
And we have to talk about the trade because there is a very specific, somewhat outrageous way to play this volatility. Yes, there is. But disclaimer right up front. We are reading the transcript so you don't have to. This is for entertainment, not financial advice. Please do not call your broker based on our crazy ideas.
Please.
Okay, let's get into the numbers. Set the stage for us. Just how big is Toast right now?
They are big, and they are getting bigger fast. If you look at the top line for Q4, revenue came in at $1.63 billion.
1.63. And what was the street looking for?
They beat it. Not a huge beat, but a solid one. And that $1.63 billion is up 22% year over year.
And just to contextualize that, 22% growth when you are already doing over $6 billion a year is some heavy lifting. That's not easy to do at that scale.
It's really not. And the metric that software investors really, really care about, ARR or annual recurring revenue, crossed a massive psychological threshold. They hit $2 billion in ARR.
$2 billion.
That's up 26%.
For anyone new to the SaaS world, ARR is the holy grail, right? It's the subscription money that shows up every year, whether the salesperson gets out of bed or not. It's the predictable stuff.
That's the idea. It is the sticky revenue. And to see that growing faster than total revenue, so 26% versus 22, suggests the core software engine is actually accelerating. It's a very healthy sign.
Okay, so strong software growth. But what about the total amount of money flowing through the system? The payment volume.
The number that blows my mind is the volume. Gross payment volume, or GPV, hit $51.4 billion.
Just in the fourth quarter.
Just in Q4.
3 months.
$51 billion. That is roughly the GDP of a small European nation just processing burgers and beers.
It shows the sheer scale of the economy that is flowing through their rails. But here's the thing. Toast has always been able to grow. The knock on them for years was that they were burning cash to do it.
Right. The growth at all costs mantra. Exactly. The critics said, sure, you can acquire customers if you give away the hardware and spend a fortune on sales and marketing. It's the old Silicon Valley playbook.
The profitless prosperity trap.
Right. But this quarter, that argument is dead. They crushed the bottom line. GAAP earnings per share came in at 16 cents.
16 cents GAAP. And the street was looking for what, 12?
The street was at 12 cents. So a 33% beat on GAAP EPS. That is significant.
And that's GAAP, generally accepted accounting principles. That's the real number, not the adjusted number where they pretend stock-based compensation isn't a real expense.
Exactly. And the GAAP operating income number really shows it. They hit $85 million in operating income. A year ago, in Q4 2024.
What was it then?
$32 million. So they more than doubled their operational profit in just 12 months.
Wow.
And if you want to look at the adjusted number, adjusted EBITDA landed at $163 million. They are printing cash now.
So high growth, real profits. And they are adding locations like crazy. I saw the net adds number, something like 8,000 new locations in Q4.
Approximately 8,000, yes. For the full year, they added 30,000 net new locations. That was a record for them. They are sitting at around 164,000 live locations total.
Okay, so if I'm listening to this, I'm just thinking, this is a slam dunk.
Yeah.
High growth, check. Real profits, check. Record customer additions, check. Why on earth did the stock trade down to 24.64? Why the almost 6% haircut?
This is where we have to leave the spreadsheet and, look at the narrative. The company's trying to pivot, and pivots are messy. Management spent a huge chunk of this call talking about new markets.
Okay.
They are effectively telling investors, look, the easy growth in U.S. small and medium-sized restaurants is great, but we need to find the next gear.
And that next gear is retail, enterprise, and international. Let's double click on retail, because this feels like the biggest shift in identity for them. Toast has always been for food. Now they want to be for it.
Yeah, not everything. Not yet, anyway. They aren't trying to run a clothing boutique or a furniture store. They are targeting what they call food and beverage retail.
So like a bottle shop, a butcher shop, a bakery that also sells coffee mugs and t-shirts.
Exactly. The places that sell stuff but also might sell you a sandwich, the lines are blurry there, and they are building what they call the unified local shelf.
That sounds like pure marketing bingo. Unified local shelf. What does that actually mean for a business owner on the ground?
It solves a massive, massive headache. Imagine you run a high-end butcher shop. You have beautiful steaks in the counter, you have wine on the shelf, you have specialty dry rubs in the aisle. You are selling to people walking in, but you also want to sell on Instacart.
Right, and the nightmare scenario is someone orders the last Wagyu ribeye on Instacart, but you sold it to a guy in the store 5 minutes ago.
And then you have to cancel the Instacart order. The customer is mad. Instacart dings your rating. It's just friction. It's a bad experience for everyone.
So Toast is trying to be the source of truth for inventory.
That's the phrase they used. They are integrating directly with Instacart to be the source of truth. They are syncing the inventory in real time.
So the Toast system tells Instacart, we are out of ribeyes, the exact second that transaction happens at the physical register.
Instantly. It's not just processing payments anymore. It's managing what is on the shelf. And it goes deeper than that. They're rolling out features that are very specific to retail, like barcode scanning on their handhelds.
Which seems so basic, right? We've had barcodes since the 1970s. Why is that a big deal?
It seems basic, but for a system built for restaurants, it's a foreign language. A restaurant deals with menus and recipes. A retailer deals with stock-keeping units. Thousands of them.
A completely different data structure.
Completely. Toast had to rebuild a part of their backend to handle that complexity. They highlighted a customer, Lockhart's Meat Market, which is a 25-location butcher and grocer.
That's a decent-sized chain, not a mom and pop.
For sure. And they're using the Toast Go 3 handhelds, the little tablets the servers use, to literally walk the aisles and scan inventory on the shelves. It replaces the clipboard and the pen.
It turns a manual, error-prone process into a digital one.
Exactly. And interestingly, management made a point to mention something that was a deal breaker for Lockhart's. It wasn't the tech, it was the support, specifically the Spanish-speaking support team.
That's a detail that often gets overlooked in Silicon Valley, but in the actual service industry, multilingual support is an operational necessity, not a nice to have.
It's a huge competitive wedge. So retail is the first leg of this new market stool. The second leg is enterprise.
This is the one that skeptics have always pointed at. They always say, Toast is great for the mom and pop pizza place, but they can't handle the big boys. They can't handle the major chains.
And that wall is really starting to crack. They announced some very big wins on the call. Papa Murphy's was the headline, over 1,000 locations.
Wow, 1,000 plus.
They also signed Potbelly, and they expanded their relationship with Applebee's. These are not small accounts.
Papa Murphy's is huge. That's a take-and-bake pizza chain. That's a high-volume, complex inventory and franchise-heavy model. That's a tough nut to crack.
A very tough nut. But the real key to the enterprise kingdom, the thing that unlocks the massive fast food chains like McDonald's or Wendy's, is the drive-through.
Right.
And Toast finally put a stake in the ground here. They announced a dedicated drive-through product is launching later this year.
I have to play the layman here for a second. Why has this taken so long? To me, a drive-through is just a window where you hand someone food and take their money. Why is that so hard from a software perspective?
It's deceptively complex. It's a timing and sequencing problem. In a sit-down restaurant, if a meal takes 12 minutes to prepare or 14 minutes, it doesn't really matter much.
The customer's just sitting at their table.
Right. But in a drive-through, every single second is measured. You have timing loops in the concrete that detect when a car arrives and how long it waits. You have to track that specific car's order from the speaker box to the payment window to the pickup window.
And what happens if you have two lanes merging into one?
Then you have a sequencing nightmare.
Hmm.
It's chaos. If car A in lane 1 orders just a soda and car B in lane 2 orders 3 full meals, but car B gets to the single payment window first, the software has to know that. It has to route the right order to the right screen for the right car.
So if Toast can't do that perfectly, they can't even get in the door with Wendy's or Burger King or Taco Bell.
Not a chance. Their whole business is speed and accuracy in the drive-thru. So this launch is basically Toast saying, we've figured out the timing loops. We are ready to compete for the remaining 40% of the restaurant market we couldn't touch before.
Okay, so we've got retail growing, enterprise unlocking drive thrusts. What about the third leg, international?
They launched in Australia. That's market number 4 for them, after the US, Canada, UK, and Ireland.
How's that going?
Management was very optimistic here. They used the term flywheel, saying it's spinning faster there than it did in the early days in the US.
The flywheel being the idea that the more customers they get, the more data they have, the better the product gets, which attracts more customers and so on.
Exactly. It's the same playbook. Land a few cool, trendy spots in Sydney or Melbourne, get some buzz, and then use that as a beachhead to expand to the suburbs.
Okay, so the growth story seems robust, multifaceted, but we have to address the elephant in the room, the buzzword that every tech company is forced to say or their stock gets, I don't know, delisted.
AI.
AI. We have to talk about Toast IQ.
We do, and the analysts on this call didn't let them off easy. They asked the real existential question.
Which is?
If AI can write code and AI can take customer orders, does your software eventually just become a commodity?
That's the question that keeps every SaaS CEO up at night.
For sure. And Toast's defense was very specific and I thought quite compelling. They are trying to shift the conversation from AI as a feature to AI as an agent.
Agentic workflows. I love how sci-fi corporate speak has become. What does that actually look like for a restaurant manager who's just trying to get through the Friday night rush?
Think of it in stages. Stage 1 was the co-pilot. You open a chatbot and you ask a question like, why were my sales down on Tuesday?
And it gives you an answer.
It looks at the data and says, well, it rained or there was a big concert across town. It's helpful, but it's passive.
Right. I still have to do something about that information.
Exactly. Stage 2, the agent is about doing. Instead of just asking for a report on who is working, you tell the AI, create a schedule for next Friday night based on the projected sales volume and staff availability. And it does it. It executes the task.
That's a huge leap. You are moving from analytics to actual automation.
A massive leap. And they want to take it even further. They talked about a future where AI handles entire back office functions. Imagine an AI agent that monitors your inventory levels and automatically orders more avocados when you're running low.
And it handles your payroll compliance and adjusts your marketing budget on Facebook based on real-time sales data.
All autonomously. You're describing a world where Toast isn't just selling software. They are replacing the part-time accountant and the bookkeeper and the marketing consultant.
They called it fractional work replacement.
That is the value proposition.
Yeah.
And their argument for why they have a moat against, say, a generic AI like ChatGPT is their data.
The vertical data.
The vertical depth.
Yeah.
They claim a horizontal model like ChatGPT doesn't know that your specific restaurant tends to waste 10% of its tomatoes on Tuesdays because the prep cook is new. Toast has that data. That's the moat.
Is anyone actually using this stuff, or is it just a slick demo video on their Investor Day presentation?
The adoption is surprisingly high. They said over half of all their locations used Toast IQ in the first 4 months it was available.
Half. That's incredible.
Over 1 million queries sent to the system. But the stat that actually impacts the bottom line right now, today, is in customer support.
Oh, I caught this. This was staggering to me.
They said over 50% of all incoming support interactions now start with an AI agent, and 70% of those 70 never reach a human being.
Let's just pause on that. That is incredible leverage. Customer support is usually one of the biggest cost centers for a company serving 164,000 different businesses.
It's a huge cost.
If you can deflect or resolve 70% of those interactions with software,
That is pure margin expansion. That's found money. That is why they can double their GAAP operating income while still investing heavily in R&D for things like the drive-through product. The AI is paying for itself already.
Okay. So we have a company that is profitable, growing fast, adding a record number of customers, innovating with AI, and expanding into huge new markets. I'm going to ask again for the third time. Why is the stock down? What was the but? What was the gotcha?
It comes down to two things, really. A hardware surprise and the curse of high expectations. Let's start with the hardware. They called it the memory chip headwind.
This feels so unfair for a company that wants to be a software company.
Yeah.
We are literally talking about the price of RAM.
We are. In the prepared remarks, management explicitly flagged a 150 basis point negative impact on margins because of rising memory chip costs.
Let's translate that for everyone. 150 basis points is 1.5%. Why does a 1.5% cost increase cause a 6% stock drop? That seems like an overreaction.
Because investors hate surprises, and they absolutely hate hardware drag in a software story. Toast has been trying to tell the street, look at us, we are a software company. We have 80% SaaS gross margins.
And the market was starting to believe them.
And then suddenly, boom, global demand for memory chips spikes. Probably because of the AI server boom, ironically, and Toast's hardware costs go up.
It reminds everyone that to sell the high-margin software, they still have to build and ship physical tablets, terminals, and kitchen display screens. They are tethered to the physical world and its supply chains.
Precisely. It complicates the model, it muddies the narrative, and they said this pressure is weighted toward the second half of 2026. So now, every financial model on Wall Street has to be adjusted down for this gross margin drag for the next year or so. It's not fatal, but it's annoying.
It's fly in the ointment.
A very expensive fly. And then there was the guidance. They raised the full year outlook. Usually a beat and raise is the best thing you can hear on a call.
It's the gold standard.
In a normal market, yes. But in this market, with software valuations where they are, the expectations are set at perfection plus. They guided for fiscal year 2026 EBITDA of 775 to 795 million.
Which is a very healthy number. That's a lot of profit.
It is, but the whisper number on the street was likely higher. When a stock runs up, 20 or 30% into an earnings print, good isn't good enough. In line feels like a disappointment. You need to blow the doors off.
And they just didn't blow the doors off. They just did very, very well.
Exactly. And there was a little nugget in the Q&A about ARPU, average revenue per user, that might have spooked some people too.
This is the downside of that new market strategy we talked about, right?
It's the double-edged sword. Your core customer, a massive U.S. restaurant doing huge volume, is paying for everything. The POS, payroll, marketing, capital loans, their ARPU is very high and growing fast.
But a new customer might not be like that.
Right. A small retail butcher shop or a new cafe in Melbourne, Australia. They might start with just one terminal and the basic software package. They aren't paying for the full suite yet.
So when you add thousands of those new, smaller customers, your average revenue per customer actually drops, or at least grows slower than before.
It's a mix shift. Mathematically, it dilutes the overall metrics in the short term, even if it's the absolute right strategic move for the long term. The bears look at that and they scream, growth is slowing.
While the bulls are saying, no, it's just a new cohort of customers that will grow and buy more products over time.
And that's the debate. It feels like the market is having a really hard time categorizing Toast. Is it a high-growth software company that deserves a 50 times multiple on earnings? Or is it a low-margin payments and hardware business that deserves more like a 15 times multiple?
The 80% SaaS gross margins say software. The memory chip costs say hardware. The transaction fees say fintech.
The market doesn't know which bucket to put them in, so when in doubt, especially in a volatile tape, they just sell the confusion.
But it seems like management has a clear opinion on the stock's value.
Right.
We saw a capital allocation signal that, frankly, speaks louder than words.
The buyback. The board authorized another $500 million for share repurchases.
$500 million. That is not pocket change, even for a company this size.
No, it's a real commitment. And they've already bought back about 8 million shares for $235 million since the program started. This is a maturity signal.
What do you mean by that?
A pure growth at all costs company from a few years ago hoards cash. They use it for R&D or acquisitions. A company that is generating consistent free cash flow starts to return it to shareholders. It's management putting their money where their mouth is and saying, we think the market is wrong about our value. The stock is cheap right here.
It's a very grown-up move. But let's zoom out for a second. Even with this story, the stock is lagging the S&P 500 significantly over the last year.
Oh, yeah. It was down about 34% over the last 12 months leading into this report. It has been dead money while the rest of tech has rallied hard.
So this earnings call really needed to be a massive, undeniable catalyst to break that negative trend.
And because of the chip costs and the just good enough guidance, it wasn't. The immediate reaction was a sell-off. The business is winning, but the stock is still stuck in the penalty box.
That is the perfect summary. Which brings us to my favorite part of the show, where we try to construct a trade around this madness, the "this is not financial advice" segment.
Please, for the love of everything, do not do this with your retirement money. This is a thought experiment only.
Okay, I'm calling this one the automated avocado arbitrage.
I'm already nervous. I don't like the sound of that.
Here is the thesis. Toast is becoming the central nervous system for the physical local economy. Their AI knows what is in the fridge. Their software knows who is working the Friday night shift. They are systematically replacing the accountant, the bookkeeper, and the inventory manager with an AI agent.
Okay, so you are fundamentally bullish on the automation of local commerce, a secular trend.
Correct. So leg one of the trade, we go long Toast. We believe in the mission. We believe in the unified local shelf.
Okay. Yeah, that's the easy part. What's the hedge? How do you protect the downside?
We short spoilage.
I don't think there's a ticker for rotting vegetables. You can't short that.
Metaphorically. We short the companies and business models that rely on manual labor and guesswork for these tasks. We build a short basket of gig economy accountant platforms. We short the companies that sell manual inventory services, the clipboard and scanner guys.
Okay.
If Toast wins, the clipboard loses.
Okay, I'm with you. Long automation, short manual labor, it's a classic pair trade. But I feel like there's a more outrageous twist coming.
The twist is how we hedge the specific risk from this earnings call. I call it the silicon sandwich.
Oh, no.
We have to hedge the hardware risk. Management told us directly. Memory chip costs are the enemy. They quantified it for us. 150 basis points of pain.
Right. So you want to short memory chips.
Better. To protect our long Toast position, we buy call options on the big global memory suppliers. Micron, SK Hynix, you name it.
That is surprisingly logical, almost clever.
Think about it. If memory chip prices spike, the chip stocks will rally. Our call options go to the moon. Yes, our Toast stock takes a hit on the margin fears, but our chip calls print and cover the loss. We're hedged.
And the other side of that, if chip prices crash,
then our call options on the chip makers expire worthless. We lose that premium. But Toast's hardware gets cheaper, their margins expand unexpectedly, and the stock rips higher. We win. Either way, it's beautiful.
It's the perfect hedge. Assuming, of course, that the correlation holds perfectly and you don't get wiped out by theta decay and IV crush on the options, which you probably would.
Minor details, minor details.
Just to be absolutely crystal clear for everyone listening, hedging a restaurant software position with highly speculative semiconductor derivatives is an incredibly complex and efficient way to lose all of your money.
Which is why we say, do not do this. It is for entertainment purposes only.
Indeed.
Okay, let's bring it back to reality to close this out. What is the final verdict here? What's the key takeaway on Toast Q4?
The verdict is execution. The business is executing on all fronts. 30,000 net new locations for the year is a phenomenal number. Strong, real GAAP profitability. A successful and accelerating pivot into retail and enterprise. The engine is running perfectly.
But the car is stuck in sentiment traffic.
The stock is stuck in sentiment traffic. That's a great way to put it. It's being punished for hardware costs, which is out of its control, and for the fact that it isn't a pure play AI story in a market that only wants pure plays. But management is looking past this quarter. They're talking about a path to $5 billion and then $10 billion in ARR.
They think they are building a generational company.
They do. And so the question for you, the listener, is really simple, and it comes down to this. Do you believe the new markets, the butcher shops in retail, the drive-thrus in enterprise, the cafes in Australia, can actually replicate the incredible success and density they achieved in the U.S. restaurant core?
Or is the easy growth, the low-hanging fruit, already gone?
That is the bet you are making.
Keep watching the tickers. We'll see you next time on The Deep Dive.